What's up guys, welcome back to the new video. I'm your host Yash from Equitymaster, trying to make markets simpler for you. Thank you for tuning in every week. Before we dive in, I just wanted to take a moment and wish you a happy Dasera. Happy Dasera to everyone celebrating. Hope this festive season brings you success and prosperity both in life and investments. Now, before we get into this week's episode, we want to take a moment and thank our friends at Help Your NGO. They have created an easy, long-term and transparent solution for individuals like you and me to support vetted NGOs while enjoying a 50% tax benefit. Check the link in the description below to donate via HYNGO and enjoy 50% tax benefit. One more disclaimer to get out of the way. This video is for information purposes only. It's not a stock recommendation and should not be treated as such. There's no opinion or view on any stock covered herein. So, with all those disclaimers out of the way, let's get started. In today's video, I'm going to talk about some debt-free penny stocks that could see strong growth in 2025. You see, penny stocks can offer an exciting opportunity for investors seeking high returns with relatively small capital. While these stocks come with higher risk, the potential for growth makes them appealing to those investors looking to get on the ground floor of a company's success. But not all penny stocks are equal. One key factor that sets them apart is the ability to remain debt-free, providing them with financial flexibility to invest in growth and navigate challenges without taking any burden of loans. As we look into 2025, there are a few debt-free penny stocks that are showing strong growth prospects. These companies have established a solid foundation with smart management, a clear vision, and the financial discipline to avoid debt. By operating with low overhead and focusing on expansion, they are positioning themselves to capitalize on the near-term opportunities in the market. In this video, we'll look at 3 such debt-free penny stocks that not only have potential for substantial growth but are also backed by strong fundamentals. For investors seeking both value and growth, these companies are worth keeping on your radar. The first stock on this list is Shri Dig Cement. The company is engaged in the business of manufacturing and sale of cement. It manufactures a range of products including Portland Pozzolana cement, OPC cement, SRPC cement and oil well cement and sells it under the brand name Kamal. In the last 5 years, the company's revenue and net profit have grown at a CAGR or compounded annual growth rate of 13% and 115% respectively. This is on the back of higher sales and realizations and volumes. The company expanded its capacity from 1.2 million ton per annum to 1.5 million ton per annum, which helped improve its realizations. This has translated into stronger return ratios as well. The company currently boasts a return on equity of 24% while a return on capital employed of 34.1%. Shri Dig Cement has reduced its debt over the years. The company is now debt-free. It also pays consistent dividend to shareholders and has a 3-year average dividend payout of 80% with a current dividend yield of over 3%. For financial year 25, the company's volume is expected to grow due to the demand from the infrastructure segment and brownfield capex to be undertaken for setting up 3 million ton cement grinding capacity from existing capacity of 1.5 million tons. The overall project cost is estimated at Rs 250 crores and is to be funded through debt of 50% and the balance through internal accruals. The capacity is expected to be commissioned in the 4th quarter of this financial year. Given the size of this project, the company is exposed to execution risk and its ability to ramp up expanded capacity. Hence, timely commencement of commercial operations within budgeted cost will remain a key focal point. However, the company's past track record of successfully completing various capacity additions provides some comfort to investors. Here's how the company's stock price has performed in the past 1 year. Moving on, the second stock on this list is Rupa International. Rupa International is one of India's largest manufacturers of heat-resistant rubber threads. It is the only Indian company to manufacture both talcum and silicone-coated rubber threads. The company's products are used in niche areas such as toys, meat packing, medical webbing and bungee jumping cords. It has also expanded its business to the hygiene segment after acquiring Premier Tissues. Rupa International currently has a manufacturing capacity of 20,000 metric tons and is actively expanding its capacity to meet the growing demand for rubber threads. It has a strong domestic presence and exports to over 30 countries globally. In the last 5 years, the company's revenue has grown at a compounded annual growth rate of 17%, led by high demand for rubber threads. The company's net profit has also grown at a healthy rate of 6% during the same period. Rupa International is also debt-free, leaving a higher scope for the company to take leverage in case there's any expansion plans. Rupa International has been consistently paying dividends as well in the last 3 years and has a 3-year average dividend payout and a dividend yield of 24% and 1.5% respectively. The company's brand Rupfil, which has enjoyed the reputation in India as well as internationally, remains one of its core strengths. This is helping Rupfil to make inroads into more and more international markets, which remains unexplored as of now. Though there has been some slowdown in the markets in the past couple of years, the innerwear and garment market are expected to bounce back with a healthy growth rate. Here's how the stock price of Rupa International has performed in the past 1 year. Moving on, the last stock on this list is Singer India. The company is engaged in the business of trading and manufacturing sewing machines and related accessories, and it also trades in domestic appliances. It follows an asset-light model through outsourced contract manufacturing, plus it also has a back-to-back warranty with vendors for major defects. Singer India has not seen a healthy growth rate over the last few years. Entry of several large players in the consumer durable segment over the past few years have led to significant price competition, which has adversely affected the operating profit of the company. However, Singer India is expected to improve in the coming years. The company's debt-free status is also expected to support this growth. In the current financial year, the company is working on value engineering and reducing costs to offer better products at competitive rates, with the objective of improving its gross margins and capturing a higher market share in the overall industry. It plans to grow the industrial sewing machine segment by introducing a new range of efficient sewing machines at reasonable prices to effectively compete and expand its market share in this flourishing segment. The household zigzag machines have an incredibly low penetration in India and offer immense potential for expansion. Singer India intends to introduce a new range of machines in the household zigzag category with the additional capability of embroidery. It also plans to drive profitable growth in the appliances segment by increasing its brand familiarity and through premiumization. Recently, Rakesh Jhunjhunwala and Associates acquired shares of Singer India. The Super Investors company holds 4.3 million shares of Singer India, which accounts for almost 7% of the total portfolio as of June 2024. Here's how the stock price of Singer India has performed in the past 1 year. So there you go. These were just some of the penny stocks to add to your watch list and track their developments. Apart from the above names, there are some more companies that Equitymaster's powerful stock screener threw when we ran a query for the top quality debt-free penny stocks. Here are some of the names that you could track. In conclusion, investing in penny stocks can be a high-risk, high-reward venture, but focusing on debt-free companies with strong growth potential can help manage some of that risk. The 3 companies highlighted in this video offer a combination of financial discipline and growth prospects, making them stand out in the world of penny stocks. By operating without debt, these businesses can reinvest profits, scale operations, and pursue growth opportunities without the constraints of interest payments or looming liabilities. However, it's also important to remember that penny stocks are still inherently volatile, and even debt-free companies aren't immune to the entire market fluctuations, competition, or industry challenges. Investors should do thorough research and consider their own risk tolerance before making any decisions. That's it for today. Don't forget to like this video and share it with like-minded investors and make them smart as you are. If you have any feedback, do let us know in the comment section below. See you in the next video next week. Happy investing, guys.